Good afternoon and welcome to our economics update with Alison Stuart, who has recently been appointed as the agent for the North West for the Bank of England. She recently took over from John Young, who we previously worked with really closely, so we're really looking forward to building a strong relationship with Alison going forward. Just a little bit of background. Alison rejoined the bank from the International Monetary Fund based in Washington, DC, where she was a division chief in the Asia Pacific department. And she's also held positions in strategy, policy and review. So just before we start, a little bit of housekeeping, just to let you know the session is being recorded and will be available after the event along with the slides. You'll receive our post-event email with all the details along with a link to the feedback survey. If you can complete the survey, it'd be really appreciated, just so that we can learn what everybody would like going forward. If you could keep your microphones muted and your cameras off during Alison's presentation. You're very welcome to pop your questions in the chat box as we go along. And then at the end of the presentation, if anybody would like to ask a question directly, they can raise their virtual hand and Alison will ask you to pop your microphone and your camera on. So without further ado, I'm delighted to introduce Alison Stuart.
Thank you very much, Nicola, and thank you everybody for attending this session. What I'm going to present is the MPC's monetary policy report from February, which we published on the 4th of February. If I just go to the start, what I will present is on the economic outlook, the policy decision which was made at that time, and then we'll move to Q&A. And I should add that I also would like to build very close links with Pro Manchester. I know my predecessor had very strong and good links with you all. And we're also look to talk to many firms on a bilateral basis each year to get a good impression of how the economy is actually moving on the ground, so to speak, where we can get information about different trends much more quickly than perhaps we can see in the official data. And so this is a very important time, obviously, for doing that during the pandemic and as we recover. And so if anybody would like to be added to our list of bilateral contacts, we'd very much welcome that. And I will give you some links at the end where you can send us an email for us to add you to the list. So the policy outlook that the MPC were discussing in February, obviously that preceded that this report was published on February the 4th, and it preceded two important pieces of news. That is, first of all, the government's roadmap of the exit from restrictions, which we heard about on the 22nd of February, and of course yesterday's budget. So the information contained in both of those will be taken into account in future monetary policy decisions. The next MPC decision will be published on March the 18th, and the next full monetary policy report is due on May the 6th. So first, if I step back and we look at activity in 2020, can I just check you can all see the slide on activity? Okay.
I can see.
Great, thank you. So if we look back at 2020, first of all, obviously we saw a huge drop in activity during 2020 with the nadir in April. And we saw a recovery through to November, but then activity receded as we saw tiered restrictions and lockdowns re-emerging over the autumn months. Likewise, there was a large increase in a big shock to employment, with HMRC reporting that there were 800,000 fewer employees in 2020, so a huge shock to activity. Since November, of course, between November and February, the February MPR, we also saw an unfortunate resurgence in COVID cases with second waves in the UK and in some other economies around the world. And we saw that mobility fell back quite sharply, though not to the same extent as in the first wave of the pandemic. So in the near term, the MPC projections were that activity would drop off quite sharply this quarter, so that it would be 4% lower and down 12% in total since prior to the coronavirus crisis. The consensus was that the drop in activity was pretty sharp, but not quite as sharp as during the first wave of the crisis, which was consistent with the idea that businesses and households have aimed to adapt to the lockdown conditions by offering, for example, takeouts, and individuals and businesses have changed spending patterns somewhat so that the retrenchment of activity was not quite as sharp as in the first quarter of 2020. Nonetheless, we're expecting quite a sharp dip in activity in 21 Q1. And when we look at the labour market, we see that furloughs and redundancies also increased in the second half of 2020, and the data on the labour market was actually quite volatile. So it's here that we're looking for some information from our contacts with businesses as we talk to them in our bilateral meetings. We saw that unemployment rose to 5.1% in December. So that's the negative news. On the positive front, we had the highly positive news on the vaccine rollout between December and February, which definitely shows light at the end of the tunnel, and the restrictions and an expectation that the restrictions can begin to ease. So if we look at the chart on the right hand side here, the share of people who believe it would take less than a year for life to return to normal has risen somewhat recently. And the MPC assumed that the restrictions would remain in place in Q1 and Q2, but would begin to be eased in Q3 and would be fully lifted by the end of Q3. And so that is slightly slower than the possible dates which were contained in the government's February 22nd roadmap. Importantly, underlying the MPC's forecasts were also the announced fiscal policy support, that support which had been announced in the previous budget and which was providing a lot of support to the economy in 2021. And obviously when they review the position next week, the week after, they will also be taking into account the news of the extensions of that support through to end September that we saw in yesterday's budget. So when we look forward, we're looking very much at what's been happening to consumption and household incomes. And as you see on this chart, household incomes have held up very well in comparison to consumption, largely down to things like the furlough scheme. And what this has resulted in, as we see on this chart on the left, is a high level of excess savings by households. So the MPC estimates that the total stock of excess savings is around about £125 billion, which is very sizable. If we look at the right-hand chart, though, we see that these savings are not equitably distributed. The high income and middle income households and retirees are the ones who've increased their savings by a lot. If we look at low income employees and also the unemployed, their savings have reduced substantially. So big question for the forecast is what will happen to that spending, that pent-up saving over the forecast? Will there be a sudden release of pent-up saving which is reflected in a sharp increase in demand, or will people be more cautious in terms of thinking about the savings that they hold, wanting perhaps a bigger buffer of precautionary savings, or will they use it to pay down debt? And so this is an issue that we're discussing with firms on a daily basis, and we're looking at closely with all our contacts as we move through April, May, June, July. How does demand from households pick up going forward? By contrast, when we look at investment, we see that investment intentions remain very weak. They were at historically weak levels. They've picked up slightly, but still almost 40% of firms do not expect COVID-related uncertainty to be resolved in 2021. And so the MPC's projections assume that whilst business investment does begin to recover as sales increase and uncertainty declines, it will do so at a much slower pace than household consumption. And over the longer run, the MPC is also factoring in some long-term scarring from the pandemic, which constrains the overall supply of the economy relative to what it would otherwise have been. And lower investment may actually weigh on innovation, productivity and the capacity of the economy for some time. So bringing this together, overall, the MPC is projecting a turnaround in GDP with the trough this quarter in 2021 Q1 and a pickup thereafter on the back of increased household spending and continued fiscal support. That is fiscal support that was in place prior to yesterday's budget. The forecast also assumes that households spend around 5% of those accumulated excess savings. So there is quite a sizable upside risk there of a potentially bigger release of pent-up demand, which could boost activity on the upside. Similar to November's projections, the MPC also assumes that the output gap closes with capacity back to potential by 2022 Q1, and in 2022 GDP growth then begins to slow as some of the longer term issues such as structural change in the economy after an initial bounce back come back more to the fore. I have to say there are also substantial uncertainties and risks around the projections, not least still about how the pandemic progresses, how the vaccine rollout continues, and how restrictions are eventually eased and the policy responses in the UK and in the world. Obviously, the February 22 roadmap gives some hints to this, and the very good rollout of the vaccine so far is also positive, but still a great deal of uncertainty. If we look at unemployment, the MPC was projecting in February that unemployment would still rise sharply and peak at around 7.75%. And that's in the near term, and then that it would begin to fall back as activity recovered. Note that the government's budget announcements yesterday, which imply extending the furlough scheme, will likely affect the timing, scale and pattern of unemployment going forward. And so the labour market more generally is another issue where the agents are looking closely at developments, discussing with firms what your employment intentions are and how you see the outlook. So looking now at developments in the economy on prices, last year's one-off cut in VAT and also the drop in commodity prices and especially oil prices at the onset of the pandemic pushed inflation down well below target, and inflation remained well below target at 0.7% in January. But what we are expecting is that as these effects wane, as the cut in VAT drops out of the annual comparison, and given recent developments which have seen oil prices rising again, the MPC expects inflation to pick back up to target actually quite quickly. And also, if we look at firms' costs, we see that whilst there has been a drop in input costs, firms' overall sales volumes dropped by much more. And so actually implied unit costs rose. And so what we see from the right-hand chart is that to some degree, especially on goods prices, this partly offset the downward pressure on inflation thus far. And so overall, the MPC judges that inflation will rise back to target quite quickly. As activity recovers, inflation picks up, but they also note that some of the upward pressure that we've seen on unit prices should also dissipate as sales volumes increase. And so they're anticipating and expecting that actually inflation gets back to target and pretty much remains very much around target over the next few years. But it has to be said, there is a very wide range of uncertainty surrounding this forecast. If you look at the fan chart here, it's got a very wide span from over +5 to down to below -1.5. And this is actually double the size of the usual fan chart. And there are risks both on the downside and the upside. And some of you may have seen that there was a speech last week by our chief economist, Andy Haldane, that focused on these risks, both on the downside and on the upside. On the downside, there's obviously the possibility that caution may hold back consumers and the psychological scars may slow the pace of the recovery, and so demand might be quite weak, which may also keep inflation below target. On the upside, consumers do have the stock of excess savings that I showed earlier, and if they are more confident, there's a possibility that they could spend more quickly, and that demand could bounce back more quickly, and that this could add to price pressures, especially if firms are not easily able to ramp up supply in response to demand quickly enough. More broadly, the speech also pointed to some long-term trends that had contributed to low inflation over the past couple of decades, which may now be reversing. The first of these was globalization and the integration of supply chains around the world, which over the past couple of decades has pushed down import prices and pushed down prices globally. And that has reversed somewhat with trade tensions between major economies in the last few years and the imposition of tariffs. The second area is demographics. Over the recent past, the world has benefited from an expanding labour force especially in emerging economies. But that is also reversing. And we're seeing ageing in advanced economies, but we're also seeing it in a number of emerging markets as well. And so the expansion of the labour force that has helped keep costs down may also be reversing. So that shows the very wide range of uncertainty that underlies this projection. Now, until now, I've not mentioned Brexit. And that's because actually the deal that was signed in December was very similar to the assumptions that the MPC had made in its November monetary policy report, and actually also prior to that. And so there was no noticeable change on the forecast from that trade deal. This did not imply no effect. It implied that in the near term, there were adjustment frictions assumed which were reducing trade and GDP by 1% in the first quarter of 2021. The intelligence that we've received through our bilateral discussions among the agents is that actually there have been reduced trade volumes in the first couple of months this year, but it's also too early to tell the extent and length of disruption. But here again, a discussion of the supply chains and any difficulties that you are seeing in terms of costs or delays in import or export are things that we are looking closely at and passing back the intelligence to the Monetary Policy Committee. So summing this all up in terms of the policy decision, the MPC expected that inflation would return to target and the output gap was expected to close. And the risks around that for outlook in early February were somewhat more balanced given the very positive news on vaccines and the vaccine rollout. And so the MPC considered the stance of policy to be appropriate, with the bank rate at 0.1% and with QE expected to reach 895 billion by the end of the year. They also left guidance around future policy unchanged, and that guidance is that the MPC does not intend to tighten policy until there is clear evidence that significant progress is being made on eliminating spare capacity and achieving the 2% inflation target sustainably. So that comes to the end of my quick presentation on the outlook. As I mentioned at the beginning, we are very much looking to speak to as many firms as we can on a regular basis. And if you would like to be added to our bilateral list of contacts, please do contact me or contact the Northwest Agency email addresses, which are shown here. Also, if you want to read more about the Monetary Policy Report, I've left the link there. So I'll finish